In episode 220, we talk about the worst thing that can happen when it comes to compounding. Stick around. Welcome to the Mullooly Asset Show. I'm your host, Tom Mullooly, and this is episode number 220. Thank you for tuning in. I got started as a broker back in the beginning of 1986. That is a long time ago. It was over 34 years. It's almost 35 years. But what I want to point out to you is that when 1986 began, the Dow Jones was at 1550, 1550. Yesterday, we're recording this on Tuesday, November 17th. Yesterday, the Dow Jones closed at 29,550, just a stone's throw away from 30,000. That's 20 times the value of what it was when I got started in the business. If you take that number and chop it up into annualized returns, you're talking about 8.86% per year. That does not include dividends. The S&P 500, pretty much the same story. It started in 1986 at 205. Yesterday it closed at 3,626. Again, big returns, but on an annualized basis, you're talking about 8.6% a year without dividends. So in 1986, president was Ronald Reagan. And unfortunately, around that time when I got started in the business, the Challenger had just blown up on CNN. Everybody got to see that. But one of the things that we were told is that the market had been so good for a couple of years going into 1986 that we'll never see those kind of returns ever again, and that people should prepare for lower returns from stocks going forward. We heard that in 1987 after the stock market crash. We heard it throughout the 90s. Prepare for lower returns from stocks. We've heard it pretty much ever since, 35 years now. So this also included a period of time where from 2000 through into 2009, there was a period there, 10 years, where stocks returned this much. Nothing. We still wound up getting better than 8.5% per year from the Dow Jones and the S&P. So is it a straight 8.5% per year? Is it a straight line up? No, never. There's probably not a single year, if you go back into this time period and look at it, there's probably not a single year in there where we returned 8.86%. It just doesn't happen. You're going to get years where you make 20%. There's going to be years where you lose 7 or 12 or 15%, and everything in between. When I got started as a broker in 1986, I was 23. I was turning 24. A week ago, I turned 58 years old. So it's almost 35 years. The reason why I'm bringing all of these numbers up is because if you start investing at age 30, 35 years takes you to age 65. If you start at age 35, this covers a period until you're 70. Even if you're a retiree and you tell us, hey, I can't really afford to take another hit, think again. Just think again, all right? If you start doing this at age 60, you're going to be covered for the rest of your life. What we're talking about is the story of compounding. That's all this is just put money away somewhere, don't touch it, and let it continue to do its thing. Starting a business, saving money, investing, it's all the same. The returns are so small to see that first year, 2 or 3, but you've got to give it time. You've got to let this thing compound. The worst thing you can do when it comes to compounding is interrupting the compounding by worrying about, oh, this election is the most important election we've ever had in our lifetimes, or this economy is the worst thing we've seen since the 1930s, or there's a pandemic, we have to rip up the script and change our investment strategy. All wrong. All wrong. Very different from what you're hearing today when you turn on TV or look at the financial papers, websites, where they talk about, here's how to make a, quick 20%, or here's the next strategy you should have for 2021. The strategy that we've had for the last 35 years tends to work pretty well, and I think it'll work for you too. If you've got questions about this or the compounding machine, just get in touch with us. And if you're watching this on YouTube, make sure to hit that red subscribe button and share it with your friends. Thanks for watching episode 220. Catch you next time.